Hello and welcome to the Weekly Outlook at XM.com. I'm Maria Pachurdes, and joining me is Senior Investment Analyst Rafi Boyadjian. We'll be reviewing the week ahead. So Rafi, let's begin with Australia. We'll get Chinese manufacturing PMIs on Monday and Australian retail sales on Friday. Is any of this data likely to attract attention, given that we have an RBA meeting coming up on Tuesday?
Well, Maria, on the whole, we're not expecting a huge reaction to the data, though the Chinese manufacturing PMIs on Monday could set the market tone. It was actually a strong end to 2024, the global manufacturing sector, including, of course, China. But in January, we had increased number of lockdowns around the world, including China itself. They had some clusters there that led to some cities coming under new lockdown rules. So it's going to be interesting to see whether or not that strength in the sector was held up in January. So that could potentially weigh on markets if there are any negative surprises. Now, looking at the RBA decision, we're not expecting any changes there. So the RBA will probably stay on hold for the next few meetings, though the RBA will also be publishing their quarterly monetary policy statement, and so that could attract some interest because it's going to be interesting to see whether or not the RBA policymakers what they make out of the recent developments as far as the lockdowns in China, which could impact Australia because, of course, China is Australia's biggest trading partner. So if those lockdowns start to hurt Chinese growth, that would be negative on Australian exporters. We also have, of course, Biden winning the presidency and also getting control of our Congress and the prospect of more stimulus in the US. Because of that, whether or not that would have changed the outlook for the Australian economy as well. And of course, with the vaccine rollouts getting underway. So those forecasts could be some sign of whether or not we're likely to get more stimulus from the RBA this year.
Okay, moving to the UK now. The Bank of England will meet on Thursday and present its findings regarding the impact of negative rates on the banking sector. Is there much of an appetite right now among policymakers to take rates into negative territory? And how might their remarks affect the pound?
So going with the recent remarks that we've heard from policymakers from the Bank of England, there seems to be waning enthusiasm for negative rates. So this review that they've been carrying out, the findings which were expected to be published on Thursday, hopefully should provide some clarity. So although based on their recent remarks, including, of course, those of the Governor, Andrew Bailey, we're unlikely to see rates being cut into negative territory in the near future. But what is the Bank of England going to do with those findings? Are they going to keep their options open, or are they going to close the door on ever adopting negative rates? If they decide on the latter, that could have a huge impact on the pound. We could see a big boost in the pound because although rate cut expectations have diminished somewhat in recent weeks, there are still some expectations of negative rates. So if those negative rate expectations are completely priced out, that would further boost sterling. Now, on the other hand, the UK economy is still struggling. We still have lockdowns across much of the UK, and those lockdowns are unlikely to be lifted. They're unlikely to be lifted until the spring at the earliest. So is the Bank of England going to be more concerned about this prolonged period of lockdown? Are they going to revise down their forecast because they're also going to be publishing their quarterly projections? So if we do get a more dovish sounding Bank of England, that could somewhat offset any potential gains for sterling should negative rates be ruled out.
Okay, turning to the Eurozone, we'll get the preliminary estimate of fourth quarter GDP on Tuesday. Given the ongoing lockdowns across Europe and vaccine supply problems, are we expecting gloomy numbers? And how about the outlook for the euro?
Well, we've already had flash GDP readings out of Germany, out of France, and actually in both cases they've beaten expectations. So it's more likely than not that the Eurozone GDP numbers will also surprise on the upside. Whether or not it's going to make a huge difference to the euro, probably not. I think we're more likely to get a reaction if there's a negative, if there's an unexpectedly disappointing reading in the GDP numbers. But I think overall, the current situation, as far as the lockdowns are concerned, is already priced into the euro. Now, the bigger question marks are around the vaccine rollouts. So the EU has not only been slow at distributing vaccines across its population, but they're also having supply issues now. So the EU is lagging other major economies such as the UK and the US in terms of vaccinating its population. And now there's another problem as far as the euro is concerned, because the ECB is making a renewed attempt to talk down the euro. They've really been trying to make a case for a weaker euro lately. So those two factors could weigh on the euro in the near term. So on the whole, unless there's a huge surprise in the GDP numbers, we're not expecting a huge impact on that in the Forex markets.
And finally, over in the US, we're going to get the non-farm payrolls report on Friday. If the numbers disappoint, what potential reaction can we expect in the dollar? And is there anything else we should be looking out for?
Well, back in December, we did see the US economy shed jobs for the first time in 8 months. And although we are expecting a bit of a rebound in January, it's only going to be a modest one. So forecasts are for 85,000 jobs to be added. So that's not a lot given recent standards. And it definitely signifies that the recovery in the labor market is still slowing, and the jobless rate is expected to stay unchanged at 6.7%. Now, we're also going to get the ISM PMIs, both the manufacturing and non-manufacturing PMIs. So if we get some positive numbers, more strong numbers out of there, that would, of course, be a positive for market sentiment. But the dollar has been edging higher this past week, and any disappointment overall in the US data next week would probably push the dollar further up, because it would spark more risk of sentiment. But that's not the only factor we should be watching out for, because there are some reports that the Democrats might decide not to go for a bipartisan deal as far as Biden's $1.9 trillion stimulus plan is concerned, and instead follow another route, which is the process of budget reconciliation. So this way they would avoid having to seek the Senate, the 2/3 majority in the Senate to get the bill through. Now, if they do go ahead with this method, that could be positive for the markets on the one hand, but again, it could take a while before they actually manage to get it through all the way. And until then, the heightened tensions between the Democrats and Republicans could be negative for the markets as well. But on the whole, any positive progress on the stimulus front would be positive for sentiment and negative for the dollar.
Rafi, thanks so much. And thanks for joining us at XM.com.